be advised that this recorded webinar has been edited from its original format, which may have included a product demo. To set up a live demo or to request more information, please complete the form to the right. Or if you are currently not on CSE Global, there is a link to the website in the description of this video. Thank you.
Hello everyone, and welcome to today's webinar, The Future of Private Funds, Where Do We Go From Here? My name is Christy DeMayo-Ziegler from the CSE webinar team. Now I have the pleasure of introducing Karen Walsh, the National Director of the Financial Executives Alliance. Karen?
Thank you, Christy, and happy holidays, everyone. Thank you for joining us. As Christy said, my name is Karen Walsh, National Director of the Financial Executives Alliance. The FEA is a complementary networking group owned and operated by First Republic Bank for senior financial executives of alternative investment firms and their finance teams. We offer events with tremendous partners like CSC, both online and in person, in Massachusetts, New York, Connecticut, California, and Florida. If you're not yet a member of the FEA, please take a moment to register, www.feai.com. As a reminder, the views expressed in this webinar are the views of the presenters and do not necessarily reflect the views of First Republic Bank, its subsidiaries, or the FEA. We have a robust agenda today, so without further ado, I'd like to introduce one of our extraordinary New York board members and today's moderator, Christy Trieste, founding partner and CFO at Motive Partners. Christy? Christy, I think you're on mute.
Thank you. Sorry about that. Thanks, Karen. It's great to be here today. As Karen said, I'm Christy Trieste. I am the CFO and founding partner at Motive Partners. Motive is an investment platform that was founded in 2015. We have about $4.8 billion of AUM, and we invest across ventures, growth, and buyout. I'm really excited for our conversation today. We have with us Anne Aquilari from CSC and Ken Robinson from the CFA Institute. So I'm going to let each of them give a quick introduction, and then we'll just dive right into it.
Thanks, Christy. And a big thank you to Karen and FEA for allowing us this opportunity. I really appreciate it. So Anne Aquilari, I've been in the industry, private capital industry since '93. I'm a really good hairdresser. That's my old joke. I always go to that. Really happy to be here with you, sharing the insights that we received for the PEI Expense Survey and sharing some other information that Ken will be able to go into extraordinary detail on with regards to the benefits of the Global Investment Performance Standards. And with that, I'm teeing you up, Ken.
Thanks, Anne. Hello, everyone. I'm really pleased to be with you all today. It's a big honor. I too would like to thank FEA and CSC for having us. I'll be talking a little bit about CFA Institute and the GIP Standards. In terms of background, I spent about 20 years in public accounting, where I specialized in funds on the audit side. Joined CFA Institute in 2008 to work on the Global Investment Performance Standards. Originally, predominantly to help out on the technical side, but over the last couple of years, I've been working more on the outreach of the GIP standards and our other codes and standards as well, which is something I really enjoy. So back to you, Christy.
Thank you. So I think we're going to go ahead. I'm going to pass it on to Anne, and we're going to start with our first slide here.
Yes, so we have an action-packed agenda, so we're going to move fairly quickly. But again, if you have questions, put them in, and if we can get to them, great. If not, we will follow up afterwards. So first, a few slides on CSC. As you can see, global company, lots to offer. I'm not going to spend a lot of time because we have so much that we have to get through. But I do want to highlight the breadth of services, and also that most likely someone from CSC will be reaching out to you. So if you do have any questions, pick their brains, especially with regards to, as you can see, the multiple jurisdictions. It does seem like our industry has gone jurisdiction happy. And if you have an org chart with more than 20 boxes, things like entity management, those capabilities might really resonate with you. So jumping right into the heart of the presentation, I thought this audience might really appreciate some levity. So it's been quite a year, lots going on, and I don't know if you can read it, but the caption of this cartoon is, "Your mother and I are feeling overwhelmed, so you'll have to bring yourself up." So, so that it seems like that has been that kind of year for our industry. So as you can see in the demographics of the survey results, no surprise here, majority of the respondents were CFOs, very much aligned with this audience demographics, growth equity, buyout. This audience definitely has more of the debt components, but those align very nicely with, especially when it comes to fees and expenses, the best practices or issues are very much aligned between buyout and the debt funds. A little bit more of the demographic overview of the PEI survey, so you can see the alignment with your own responses. The majority of the audience for that survey was straight middle market funds, under $2 billion in assets under management, and pretty diverse across the U.S. This was only really a U.S.-based survey, but we managed to hit most corners of the country. So let's get into a little bit more detail on a specific topic that is very much of interest to firms like yourself, investors, and the SEC, and that's broken deals. So you can select all that apply. Again, try to go quickly and honestly, and then we're going to show you the results from the PEI survey of the same question. So, Christy.
Yeah, so I thought this was an interesting question because we're a pretty hard. We charge broken deal costs to the fund. I imagine that the SEC wants that to change. So I'm really intrigued to see what the answers are here.
Okay, let's find out. So 40% charge all broken deal expenses with some offsets. I mean, you can definitely see, termination fees being offset against that. This is interesting that the broken deals, again, we're starting to see more complexity around the treatment of broken deals expenses to capture alignment between the firm and the investors. And then we'll show you what the actual PEI results were, which is, again, Christy, to your point, predominantly all broken deal expenses are charged to the fund, although you'll see over time, we've been doing this survey for quite some time, so you see that drifting down a bit. You do see these offset features, again, the complexity increasing a bit. Just to point out a little historical background to why broken deal expenses are charged to the fund, and that is because of the dilemma, some would call moral dilemma, but it's really an economic dilemma that a firm will face if they have done a lot of due diligence on a transaction and it doesn't close, and then the management company has to absorb all those costs. So you might imagine historically there might have been instances in that situation where the firm actually did the deal and maybe didn't want to. And so for the alignment and to get away from that economic dilemma, the industry evolved into having broken deal costs absorbed by the fund. So there wasn't that economic dilemma. But again, that communication and the kind of abilities to offset the impact of that by using termination fees and things like that are super important. But like everything else in life, if we forget our history, we're doomed to repeat it. So that is the core reason why this evolved in the first place in our industry. Let's not forget that.
And that makes a lot of sense to me. I would say for us, while we do charge the broken deal expenses to the fund, we are very communicative about them. We have two LPAC meetings a year, and we really go into the detail of what they were, what the broken deal expenses were, and for a little detail around the deals and why we decided not to proceed with them.
That is great advice. Communication goes a long way to avoiding, mistakes. Okay, so a little bit more on broken deal expenses, co-investors, right? I mean, that also is something that has evolved in our industry over the last few years. And then, the question that the SEC and some other investors, especially those investors that are not participating in a co-investment strategy, ask is, hey, do these guys get a free ride? And you can see from the historical results, no clear winning practice is evolving in our industry. You kind of have a third of the people, yes, we do charge it if the entity has been formed. You have a third of the people saying, no, it's just a fund expense, and then some options in the middle. So we really don't have some clear direction that's just naturally evolving within our industry, something to keep an eye on. So let's poll the audience here about, how impactful are these offerings of co-investments to either your existing investors or both existing and prospective, because we're also seeing a lot of clients use this as enticement to introduce their firm to new prospective investors.
Yeah, and I would say we are big, because we're a newer firm, we started with a smaller fund. So co-investment has been a big proponent of, one, our fundraising opportunity, giving investors the opportunity to invest alongside the funds, and two, our ability to make investments. And I would say on that previous question, and I'm sure others feel this way, it really depends if the co-investment is something we negotiate upfront or it's a syndication. If it's an upfront negotiation, we're going to get those potential co-investors who are coming along with us to cover the broken deal expenses. If it would have been a syndication but didn't end up happening, that's when really the fund ends up picking it all up.
And again, to your earlier point, as long as that's communicated, especially to the investors not participating in a co-invest strategy, that's the key. Okay, so let's see the results of this. So, okay, bit of a mixed bag here. So yes, some firms are definitely using it, again, both with existing investors and then to become known to more prospective investors. So that's quite interesting as well. So let's dive a little bit deeper into when you are using a co-investment strategy. What are some of the other fees that can be charged besides broken deal, can be considered as something that the co-invest vehicles participate in? So you can clearly see it's pretty understandable that the actual setup of the entities would be the responsibility of the co-invest vehicle. So that's organization and setup. So if you're not doing that, that is something to be proactively discussing with your co-invest partners. What's a bit more interesting is you see this, again, it declines over time, a carried interest payable that's equal to the fund. So that tends to be going away, although what's pretty much kind of staying relatively steady at about a third is a carried interest, but less than what's paid by the fund. And then obviously you have the 50%, or about half, which means half are doing some kind of carried interest, which again promotes alignment and also gives an indication to your participants that are outside the co-investment strategy that, the co-investors are contributing to the overall growth of the firm through carried interest. But here we have, again, very little, a very small portion of the co-invest vehicles are picking up any kind of management fee. So, Christy, how are those conversations going for you guys?
I wish we could say we collect management fees on co-invest, but we really don't. So
it's tough. A lot of times people will say, investors will say they have a co-invest strategy in order to average down the overall weight of the management fees across their investment, which makes a lot of sense.
Yeah.
I don't think that, and again, as a fund administrator, I'll be honest with you, sometimes I feel like I'm the middle child. I'm like in between both sides. I don't think that argument is as strong with the carried interest, because the carried interest purpose is alignment and being able to, again, balance between your investors that are participating with co-investments and those that are not. It's nice to know that the carried interest is coming from both sides in order to support the growth of the firm.
I think the hardest thing with co-invest capital is the deal pace, right? So a lot of times co-investors know they have a little bit of leverage because you need them to get the deal done. So in that instance, it makes those conversations around carry or management fees more difficult. And then to your point earlier, a lot of investors invest on the premise that, and I'm sure many of the CFOs out there see this now, is a lot of the LPs have direct co-investment programs that they've created alongside their fund programs, and they want to see access to what they call fee-free co-invest.
Yep. It's definitely an evolving trend. So let's talk about management fees. Again, a little bit deeper dive into this particular topic. One of the questions that we get asked a lot, especially as a firm is either starting up as an emerging manager or moving from, the more high net worth family office into a more institutional market, is when do I start charging management fees? So we have been asking the question of the industry, because again, I think this is an important mechanism that we share back what other people are doing. Not to say, as you can see, given the various different options here, not to say there's one right or one wrong or one dominant industry practice, but it's something to keep your eye on. So 77% of the surveys respondents from the PEI survey are either charging them from the first closing, so think about that as your acceptance, right, the acceptance of the investors, or from the first capital call. And we'll get into sublines later, but they theoretically, they would be pretty close together in time. So, Christy, I don't know if you had any thoughts on this particular.
For sure. I think what's interesting about this, I wish there was a sub question, because again, we're only on our fund 2. And so of course in our first fund, the second we closed on it, we wanted to start collecting management fees because we had to start paying for the people, and we were looking for deals. Now, when we went between Fund 1 and Fund 2, interestingly, we raised that fund during the pandemic, the early part of the pandemic, actually. What we ended up doing was we did secure a first closing, but we held the management fee until we knew we had a deal for that fund. There's the balance of a successor fund, meaning you step down in your previous fund, management fees to balance, but also the most important thing is whose capital are you investing? And so the way we looked at it was we weren't going to turn the management fees on until we knew definitively we were investing our Fund 2 capital. So that's the balance you have to make as you sort of go through the life cycle of your funds and how you bring on new funds.
Yep. Great advice. Thank you. So again, as you go through the life cycle of the fund, you get into the extension periods. This is becoming more and more common. A lot of firms are consciously holding on to investments longer because they feel that there's a better exit opportunity as these companies get more mature. So, one of the questions we like to really talk about in order to get best practices into our actual governing documents, again, these governing documents you got to live with for, up to 15 years. So does the LPA provide a management fee charged in the extension period? And more than about 50% said, yes, it is covered, same rate. And, you get up to another, almost 2/3 by saying, yes, it is covered with a reduced rate. But you still have this, call it close to 30%, where it's not provided for in the LPA. And that could make for some very tense moments towards the tail end of the fund's life, which surprised me.
Yeah.
So
yeah, for us,
then you talk about, well, what about, if it goes beyond the governing documents? And this is where contracted terms definitely give way to one-off negotiations, clearly. I don't. It's almost too new to say that there's been a lot of experience with this, but there's talk with the impact with the continuation funds, secondaries. This gets very complicated. So I won't be surprised if there's some questions, but we can always address them at a later point. The what ifs, right? The what if scenarios. Then, if you are in that extended period beyond your governing documents, and you're doing some kind of restructuring, which can come in many different flavors, who's paying for that? So in this case, again, because I think it's so new to our industry and we don't have any clear practices, forget about best practices, 77% are saying we decide at the time. We're going to figure it out if and when we get there. Because I consider that none of the above, maybe they'll figure it out when they get there. So again, this can be a very stressful period. And what we've seen in our experience is it takes one of two tracks. If the firm is continuing and raising more capital from either those existing investors or want referenceable existing investors, they'll go down one path. If the firm is dissolving and people are moving on to other firms, it will go down a dramatically different path. So, and none of it's covered in the governing documents. The lawyers, that's when the lawyers come in. So now that we've talked about a lot of the complexities that you're facing with your firms, let's talk about some of the things of, on your wish list, who would you like to have assistance from? Fund administrators, valuations, data management, data security, or your wish list is too long even for Santa. And please be honest, and again, you don't have to vote for fund administrator just because of me, but please be honest and please be quick. So.
Yeah, it's funny, actually, my wish list, my request from Santa is technology. Again, because we're at the stage we're at, we have just sort of stabilized on people, but now we know to really scale, it's thinking about the technology. So I guess I would also say it's interesting because we're looking at fund administrators. We have one for our Fund 1 and Fund 2, but as we're looking towards Fund 3, we were like, let's see what exists. And the technology was a big component of the decision as it relates to the fund admin, because we all can do a ton of really hard work in the background, but if it doesn't get delivered to the right way to the LPs, it just falls flat. And that's really what we're most focused on right now. So true, so true.
And you're right, as with the fund administrator, you're stepping on not only to their expertise and to their processes, but to their tech platform. Absolutely. So this is good. There's a lot going on, right? So I think, having such a cross section as to almost evenly dispersed with regards to all of these responses is very telling. So let's talk about leveraging your vendor ecosystem. Okay, again, our industry got complex very quickly, and it's just going to get more so between the demands of the regulators, the demands of the investors, and then again, for anyone who is working overseas, between us, I used to complain about the SEC until I heard what my European and Asian brethren have to go through. And then I'm like, oh no, we're good. We're good. No matter what they throw at us, it's not that bad. So how do you navigate through this? And what we've seen with many of our clients is very successful ones are very intentional about vendor selection and vendor management. And if you're going to do that, though, at the end of the day, somebody's got to bear those costs, right? I mean, you can internally throw bodies at it, but at the end of the day, that's not scalable, and that might not be the smartest approach. So if you're going to use a third party, how do you decide if it's a management company expense or a fund expense? And again, back to Christy's point, make sure you're very upfront in the communication of it. Don't just think it's a bullet point in the LPA and I don't have to talk about it again. So you'll notice a pattern here. The top half are services that relate to really the operations of the firm, okay? Whereas the bottom half are services that relate more to the investors. And then legal fees, this is my lawyer joke for the lawyers on the phone. The legal fees, it always gets down to it. It depends. Right? You're never going to get a straight answer. It depends. So, gotta love them. So does that make sense, Christy?
Yeah, this makes a lot of sense to me, and I think you nailed it. When we think about expenses that relate to the firm, the firm is registered with the SEC, so the mock audit is paid by the firm. Obviously, we're all being dictated by what's in our LPA. So the reality is, I think where it gets probably for us is some of the technology where there are some things that we would charge to the fund that some might not charge to the fund because they just don't have the authority to do it in the LPA. So it's always following exactly what the agreement you made with your LPs as to where it's going. Another really interesting thing, we've never done it, is we have the authority for my internal team to charge, some of our expenses to the fund. And I think that was done, talk about motives is, so you can charge a fund administrator to the fund, but, internal team in theory should be covered by the management fee, but it gives you that flexibility. We've never done it. The LPs don't like it. So I imagine we won't do it in the future.
Yeah, that brings up a really interesting point. And Ken's background is a lot in the private equity real estate. Private equity real estate is much more vertically integrated internally within the firm. So in many cases, they have that situation where they can either go to a outside third party, or have an internal team on the property. But you're right. I think it's a lot easier for an investor to get comfortable that the third party is governed by competitive, forces. Whereas, am I getting the best product for the best price from an internal team? Ken, I don't know if you've definitely been in conversations on the real estate side on this debate.
Yeah, nothing to add on that, though, man. Yeah. I think that was good.
Yes, it gets complicated. Okay, so we're back to a polling question. So again, back to the point and to what we were just talking about, even though you can do something, do you do it, and how do you communicate it? How do you use reporting to communicate what you're doing with your fees and expenses to your investors?
Yeah, and I would say we have three sort of pillars of our communication. So one I already mentioned, which is our LPAC meetings. We do them twice a year. On our sort of the one that coincides with our annual meeting, we call our reporting LPAC, where we really do go into detail. We have a quarterly investment letter, which I imagine most do too. We use that as another opportunity to provide any information on any extra expenses or anything that we may have collected that isn't subject to an offset. And then the third is in the footnotes of the audited financial statements. And interestingly, I think investors read the third the least, but it has the most credibility because it's been reviewed by your auditors.
True. Okay, so let's see what folks are doing. So to your point, audited financial statements, and then some of the one-off reporting upon request. So yeah, ILPA and modified ILPA has been out there for a while, but I got to, it hasn't really picked up. And I think there's a lot of, I mean, again, as a fund administrator, I would be more than happy if we could standardize reporting. If our industry standardized reporting, we'd throw so much tech at it because, we'd be able to. We'd have some confidence in what that would look like going forward. But we just haven't seen it. There's a lot of one-off reporting still. And again, we'll have to see what happens with these SEC proposals. So in comparison, so the responses here predominantly audited financials and bespoke reporting when requested, very similar to the PEI broader survey results. 63% use audited financials and one-off reporting primarily. So very much aligned there. No surprises. So speaking of the SEC, again, be honest and quick with your response. So who's read it cover to cover? All of them. There's been plenty. Versus, and Christy, I won't call you out here, so you do not have to confess to your brethren. We'll see what people say. Okay, going on.
Well, I'll say I'm very lucky to have a dedicated CCO, so I know that she has read it cover to cover.
Yes, that is key. So, and again, thank you to the audience for your honesty. Yeah, it's been, and like Christy, I mean, we, CSE, we're in the business of compliance. It's just been so hard to keep up. And then even when we read it and then we bring our people together and we're like, what did you see? And they're like, oh, I saw this. And I'm like, really? I saw that. So even trying to educated guess at what the SEC is looking for and why in order to come up with, well, if this does indeed come to fruition, this is how we're going to handle it. Again, it's going to take us a year to gear up for this. So yeah, so it's a lot going on.
And I will say, so we actually, I'm sure a lot of people out there have, these quarterly or annual meetings with their investors. You see more and more that ODD doesn't just stop at fundraising. And so we had a couple in October and November, and we used it as an opportunity to see what they were looking for, especially around the concept of creating a net across your portfolio. You can't show a gross without a net. So we said to one of our investors, like, we find you're really thoughtful. What are you seeing that your other GPs are doing? How are they approaching this? Because there isn't just one approach. And it was great. She came back with a really a thoughtful response that helped us sort of determine, okay, this is how we're going to do it. And also you have the benefit of knowing now they're going to accept what you've done because you've taken their advice of how they've seen it.
Absolutely. Collaborative solutioning, right? That's the way to go forward. Absolutely. So, and speaking of the collaborative solutioning, we did take this particular year's PEI's survey opportunity to get additional feedback on some of the proposed changes. So this might be a bit of an eye test, and I'm sorry for that. Again, you can download these slides. But what we did was we took the most prominent features of the quarterly report section of the proposed rules that came out back in February and said, okay, what does the industry think would be of value to the investors? And then juxtaposition with how difficult will it be to accomplish? So as you can see, most felt that timely reporting would be most valuable to the investors. And it actually ranked lower, ranked 4 in difficulty. Probably the biggest difficulty aspect of this is the valuation process. So that is something that as an industry we might need to work on. And then you can also see detailed expense reporting, okay, was also seen as very valuable. However, also ranked very high in how difficult that would be to implement. Again, to the extent, from a fund administrator standpoint, to the extent that there was some standard reporting, we could set up the chart of accounts. We could actually book the journal entries in accordance with these detailed reports so that we can, put some process and system behind these reports. The which is why we're watching this so carefully, because it's going to take us about a year to get that into place. Or we'll see. But what really helped me was this whole piece about covered portfolio investments. There seems to be alignment that that is probably not as valuable to investors as some of these other items. And yeah, that would be very, very challenging to implement. So I'm going to just jump to the next one, because we did the same thing for performance metrics. And Christy, this gets back to your point of, if you show gross at the portfolio level, you have to show net. So again, we saw some really helpful patterns, keys to note here, and this could be some low-hanging fruit for you to implement even before the SEC proposed rules get finalized. So you'll see that this net and gross IRR and MOIC are very valuable and not that difficult to implement. Again, we are definitely, and maybe Ken, you can wrap this into your conversation, because the how do you show net at a portfolio level was a big topic of conversation at the GIPS annual meeting, and we actually had participation directly from the SEC on this point. So that's very valuable. So yeah, so both at the gross level and the net level, very helpful for those fund metrics and not seemingly too challenging. Sublines did come up as valuable to investors, but a little bit more challenging. And again, I'll point you to GIPS, because it's been covered. So why are we trying to reinvent the wheel? So on that note, let's take a pulse of the audience as to seeing how aware they are of the GIP standards. So Ken will know how familiar the audience is with the CFA Institute and the GIP standards.
Actually, I'd love to bring Ken in now. Ken, can you tell us a little bit about the CFA Institute and the GIP standards, as everyone's answering this question?
Sure. So CFA Institute, we're a global organization. We're a not-for-profit organization, so we're not an investment management firm. We have local societies around the globe, probably about over 150 local societies. And you'll see I've got a slide on this, you'll see in a second, but our mission is to lead the investment profession globally by promoting the highest standards of ethics, education, and professional excellence for the ultimate benefit of society. And I'll talk a little bit about more in a second, but interested to see the results.
Yeah. Okay.
All over the place.
So it looks about like a third. It's either on the radar, or actually more than a third on the radar, or familiar with it, so which is helpful. 2/3 will be taking lots of notes for the next few slides. So Ken, I'll let you take it away.
Yep. Thanks, Anne. So hopefully you'll be hearing more about it in the future or soon. So I started talking a little bit about what CFA, who CFA Institute is. I'll just continue on that for a little bit. You may have heard of us from the CFA, Chartered Financial Analyst, or the CIPM, Certificate in Investment Performance Measurement Professional Designations. But we also produce investment management industry codes and standards. And I'll talk a little bit about that in a second. But I wanted to let you know you don't need to have a CFA Institute member at your organization to comply with any of our codes and standards. We do this for the benefits of the industry. In terms of CFA charter holders, we have over 190,000 charter holders and close to 200,000 members around the world. So a pretty big organization. So I mentioned that we also develop codes and standards for the investment management industry. So the most well-known are the GIP standards, which we'll be talking a little bit about today, but we also recently have released about a year ago what we're calling the Global ESG Disclosure Standards for investment management products. We also have released a DE&I code for the US and Canada, and expect to release that code, or a code, for other regions around the world as well. What's interesting about that code is it's principles-based, as opposed to more rules-based, like our other standards. And also, it's for the investment management industry. So not just investment managers, but other organizations involved in the industry can claim compliance with the DEI code. So you see not only firms and asset owners, but you see investment industry organizations and consultants like Cambridge, NEPC, et cetera, have adopted the DEI code. And I didn't put it on the slide, but we also have what we call the Asset Manager Code, which is a principle-based code of conduct for investment management firms. And over 1,000 investment management firms comply with the Asset Management Code. If you have an interest in any of these codes and standards, feel free to reach out. So GIP standards, what are the GIP standards? So the GIP standards are an investment industry standard for calculating and presenting historical investment performance. Again, I mentioned earlier, we're a not-for-profit organization, so we don't make any money off the GIP standards. The GIP standards are produced through the help of a whole host of volunteers from the investment management industry who help us put that together, and that's done through GIP's volunteer committees. Anne is a longtime member of one of our committees. If any of you have an interest in being involved, please feel free to reach out. We've got participants from not only investment management firms, but we also have participants from service providers like record keepers, GIPS verifiers, consultants, even law firms. So pretty diverse group of people involved in putting together the GIP standards and providing input on the GIP standards. As it's a global standard, we have over 60 not-for-profit organizations around the globe that are what's called GIPS standards sponsors that promote the standards. Some of them are our CFA Institute societies, but a lot of them are not. 90 of the top 24 of the 25 largest global investment management firms, either in whole or in part, have adopted the standards. That sounds pretty impressive, but I don't want you to think that the standards are just meant for the largest asset managers. They're actually not. Over 1,700 organizations have complied with the standards, and the vast majority of those, believe it or not, are small and medium-sized organizations. That's comprised or spread out, if you will, over 47 markets, so countries, if you will. I would say the majority of those 1,700 organizations that claim compliance with the standards are based in the US. We say organizations because it could be an investment management firm or it can be an asset owner. Asset owners play a critical role in promoting our standards, which we'll talk about in a minute. But asset owners can also choose to claim compliance with the standards, and a growing number of asset owners are doing so. I'm based in Boston, and in Boston, the big asset owner is Mass Prim, and they're a big proponent of all our codes and standards, including the GIP standards. So by establishing standardized requirements for calculating and presenting investment performance, it enables investment managers to compete on equal footing in all markets, so comparing apples to apples, if you will, and it enables the users of the investment performance information, whether it's consultants or investors, gives them more confidence that that performance is calculated correctly and it's got all the applicable disclosures that go along with it. There are actually more than one version of the GIP standards now. We did an update that we call the 2020 editions of the GIP standards. The standards that would be relevant for private equity firms is called the Global Investment Standards for Firms. More and more asset owners and or their consultants are asking about whether the firm claims compliance with the standards. So if you haven't gotten that question yet, we're hoping that you will. ILPA has included a series of questions in their latest version of their DDQ. It's included in many of the consultant databases out there, such as eVestment And we're seeing more interest from the consultant community and the database community in not only inquiring about our codes and standards, but also to make sure that to the extent they ask about it, that they're using the correct terminology and that they want to ensure that they're familiar with our codes and standards. So when a firm adopts one of our codes and standards, particularly the GIP standards, it shows their commitment to follow global industry best practice. And in this case, it would be for valuation, performance calculation, and performance presentation. It demonstrates a commitment to consistent, transparent, and comparable methods of calculating and presenting performance. And it requires the establishment of, and I'm sure many of you have this already, documented policies and procedures. And for a lot of this, like I said, you probably have it and you can refer to your existing manuals. But it's interesting, a lot of the firms that have complied with the GIP standards have told us that by implementing the GIP standards, it's improved their internal control process, which has cut down on errors down the road. We've made quite a few changes in the latest edition of the GIP standards. One of the biggest reasons we updated the GIP standards was because of alternative investment managers. We wanted to make sure that they were relevant for all asset classes, but particularly private equity funds and real estate funds. So I'll talk about now some of the bigger changes. Big change number one, if you will, was the GIP standards used to be oriented based on composites. We used to require firms to put everything into a composite. So even if you just had one fund, let's just say one closed-end fund, you had to put that in a composite and produce a composite report. We've moved away from that in the sense that we've organized the standards by composites and also by funds. So if you're just selling a fund as opposed to selling the strategy, you would look to the fund requirements as opposed to the composite requirements. We've also made it a lot more easier to present money-weighted returns. It used to be you had to meet our private equity definition in order to present money-weighted returns, basically since inception, IRR. And we've now made it easier to the extent that the firm controls the cash flows and it's a liquid fixed life or closed-end fund structure, you can present money-weighted returns instead of or in addition to time-weighted returns. As we've seen a lot of products that have been released in the marketplace that didn't technically meet our prior private equity definition, we've now enabled them to comply with the standards by presenting IRR, whereas before you arguably had to present time-weighted, which really didn't make sense for all these types of vehicles. We've also streamlined the performance information that would be in what we call a GIPS report. We used to require since inception IRRs and multiples and ratios going back 10 years, and now it's just since inception through the last annual period. As before, when a firm claims compliance with the GIPS standards, it's a firm-wide claim of compliance. So you can't pick and choose. You can't say, I'm going to be compliant for this investment fund and not for another investment fund. Firm-wide compliance, and the standards are geared towards prospective clients. So I would say outside of the private equity space, the way this works is when you meet with the prospective client, you would give them a GIPS report. With respect to closed-end funds, you may not have a GIPS report, particularly, if you're trying to raise money for that closed-end fund. So you would provide the GIPS report when you have that report available after the fund has started, or you would provide them the GIPS report for if you have an existing fund with a similar strategy. I also have a list of resources that in the last part of the presentation, if we have time, that we'll discuss, and mentioned the proposed private fund requirements from the SEC. We've been very involved in producing comment letters and working with other parties on both the the SEC marketing rule and the SEC proposed private funds rule, which could be a whole topic of another webinar. We've also been working with FINRA, as FINRA has released some guidance that requires conformity to the GIP standards when presenting IRR And so we'll talk a little bit about that in the resource slide when we get to that.
Excellent.
Back to you.
Yeah, thank you, Ken, so much. And I think, again, the big ask here of this audience is awareness. Be aware of the CFA Institute, its great set of coded standards, and the GIPS, Global Investment Performance Standards, especially, because it's what attracted me to that organization was its independence, right? It's not a GP-led organization. It's not an LP-led organization. It really is there to promote best practices within investment industries. And the other thing is we can piggyback off of lessons learned from many other of these investment asset classes. So super important standards board, something to get familiar with, and again, this is kind of where our industry is going. All this conversation of gross to net, like why are we even talking about it? This is the end goal. So I think we're just going to do a few more questions, and then we'll get to Ken's resources, which are super helpful, and in the slide deck. Hopefully you've downloaded it. So quick question, now that we've thrown a lot at you, we have 7 minutes left. What challenges have you had to face this year in your back office? So answer honestly, quickly, and we will jump to the results to keep things moving. Clearly, not a lot of people answered because all of the above crazy year would have been my answer. But I can show you. I'm pretty sure. Did we do this poll? Yes. So the last time we did an FEA webinar, which was in April of 21. So what I was trying to do is compare the two and see not much has changed. Almost a third, it was about staffing, and the other third was about all of the above. So probably if I had given more time, we might have gotten to a very similar response from this current period. So, and then one more thing, again, bringing you back to April of 21, when we last did this session, we were able to do a cloud, which I love the cloud polls, word clouds. So, and it was reporting and lunch were the top topics. Probably, again, something similar for today.